Inflation has certainly been the main thing on investors' minds over the last 3 months as it continued to take a hold in a broadening range of goods and services. Although certain to rise even more in the months ahead, we are confident that inflation will ease in 2023. The key questions are what level inflation will fall to, especially if a wage price spiral has become established, and what the costs of controlling it will be in economic terms. The tightrope on which central banks are treading as they navigate a path between the perils of inflation and recession grows ever narrower. It was only last summer that central banks were dismissing the first stirrings of inflation after years of dormancy as transitory. At first confined largely to oil and gas markets, inflation now seems to be evident in almost all goods and services, and, although exacerbated by these events, it can no longer be blamed solely on the conflict in Ukraine and COVID lockdowns in China. Against a backdrop of raging inflation and rising interest rates, investors in bond markets endured another wretched quarter. As a reminder, inflation is the nemesis of most bond markets because it erodes the value in real terms of interest payments and the final repayment of capital when a bond matures and is repaid, both of which are fixed. Thus, when inflation is rising, the price of a bond will usually fall and its yield therefore rise in order to compensate. Indices recording the returns of the conventional UK government gilt market were down another 7% in the second quarter of the year, taking the loss since the beginning of the year to 14%. So much for the safety of government bonds. Rising yields and tumbling prices, though, are not just a UK phenomenon. Investors in the broad US Treasury market lost 3% in the last quarter as yields continue to rise and have now lost just under 9% since the beginning of the year. Turning to bonds issued by companies as opposed to governments, growing fears of an economic downturn and the impact this would have on companies caused prices of corporate bonds to fall by even more than the equivalent government bonds. Looking forward, the extent to which bond yields have risen since their lows in August 2020 means there is now at least some scope for them to fall, and therefore bond prices to rise if economies do fall into recession. Government bonds are clearly not, though, primed to provide as much protection as they did at the start of the dot-com bust in 2000 or the beginning of the financial crisis in 2007, when 10-year gilts yielded more than 5%. The correction in stock markets deepened in the second quarter of 2022. Having lost just over 4% in the first 3 months of the year, global stock market indices slumped by 14% in the second quarter, taking the year-to-date decline to almost 18% in local currency terms. Although this provided a very rude and unwelcome awakening for many investors, it is important to put the recent performance of stock markets into perspective. Despite their falls this year, global equity indices are still up by more than 11% PA, including dividends, in local currency terms over the last 10 years. Returns of such magnitude were never going to be sustainable, and a large part of them can probably be attributed to more than a decade of artificially low interest rates and bond yields engineered by central banks. Given that the key elements of the macro backdrop were broadly the same as in the first 3 months of the year, it is not surprising that regional variations in stock market performance were similar in the second quarter of the year to the first. Amongst developed markets, the UK and Japan were the most resilient in local currency terms, and the US and European markets the weakest. Down by just 5% in the second quarter of the year and also year to date, the UK stock market as a whole continued to benefit from its heavy weightings in multinational companies which generate a high proportion of their revenues outside of the UK, old economy stocks such as mining and oil stocks, and its dearth of technology firms. Once again, though, there was substantial divergence between indices representing the performance of the UK's largest companies and of the much weaker performance of medium-sized and smaller UK companies, whose fortunes tend to be more aligned to the domestic economy. It was therefore another tough quarter for active managers who will understandably tend to be drawn to the more exciting growth prospects of the medium-sized and smaller companies in the UK. We cannot promise that share prices will not fall further in the months ahead. However, equity markets will recover, as they always do, and recent weakness is enabling many of the active managers we use in their portfolios to buy into great companies at very attractive prices. Anyone who invests in shares should be doing so for the long term, and, although the recent past has been painful, we are confident that equities will continue to provide returns which are better than inflation and other mainstream asset classes over any extended time frame.